Last week I spoke to Berenberg Bank, who described the Turkish central bank as out of touch. Yesterday, Thomas Taplin looked ahead to an extraordinary meeting as the central bank aimed to regain the reins on the lira. And today the currency soared. In a bold move, the CBRT rose rates to an astonishing 12%. But is this a double-edged sword? Joining me down the line to discuss all is Cristian Maggio. Cristian, the boldness of the actions stunned investors, stirring hopes it would short-circuit a vicious cycle of selling in emerging markets and revive risk appetite in the developed world. Analysts say the action is a huge step towards reaffirming central bank credibility by putting emphasis squarely on preserving market stability and tackling inflation, and at the same time it's faced down the government. You're just back from Turkey. What do you make of it all?
Well, first of all, I would say that we shouldn't be looking probably at the 12% interest rate, because they did hike the marginal funding rate from 7.75 to 12%, which gives the illusion of a 425 basis point hike there. And they also hiked the one-week repo rate from 4.50 to 10%, which gives another illusion of 550 basis point increase. But the reality is that the central bank has reverted to prevailing funding conditions on the repo rate, while they were used to fund the market with overnight lending rate, which is now called the marginal funding rate. So, in conclusion, the real effective tightening that they've delivered is about 300 basis points, a bit less than 300 basis points, because this is going to push the average CBRT funding cost from slightly in excess of 7% to slightly in excess of 10%. So is this enough? I think that is enough to trigger the reaction that we saw yesterday. The market probably reacted more in a act first and think later, under the illusion that tightening was a lot more aggressive than it has materially been. Now the market is looking into more details, and I think that we will see probably the bearish bias for the lira still in place over the coming months.
Looking down the other edge of the sword, in reality, how likely is it that Turkey's central bank can maintain such an aggressively tight monetary policy in the face of a sharp slowdown in growth and two major elections later this year? If you give the market what the market wants, what happens when it wants more?
Well, they are forced to keep interest rates high, right? It's clear that the CBRT didn't want to hike interest rates. They were pretty accommodative on the government's agenda to keep interest rates low, especially this year, because we have municipal elections at the end of March, and then we have in August presidential election. So Erdogan wants to go into these elections after suffering a big blow from the recent graft scandal with at least low interest rates. So the central bank tried to accommodate on that, but against the risk of a full-blown currency crisis, they were forced by the market to intervene and to hike interest rates. So they cannot step back. They cannot reduce interest rates now. I believe that at some point the market will demand more, and the real question is whether is the CBRT ready to deliver more, and I'm afraid they are not. They will not get the green light from the government. Although they are formally independent, de facto they are not, and they're following the instructions of the government in terms of interest rates. And when it comes to growth, well, higher rates are going to have an impact on growth. Growth this year will look ugly. It will be significantly below the 4.2% that Turkey likely posted for 2013. But probably this is the least of evils, because given the very large exposure that the corporate sector has to FX short positions, if they did not intervene by stabilizing the lira, that would have triggered probably a chain reaction in the corporate sector with the number of bankruptcies and a sharp increase in unemployment rate and an even sharper probably slowdown in growth. So this is probably the least of evils, but it is a sort of lose-lose situation for Turkey. at the moment.
The policy pressure has moved to South Africa, where analysts had expected interest rates to stay unchanged. Despite central banks coming to the defence of their currencies, even the aggressiveness of the CBRT's actions had merely a short-term impact on the lira, as their inventory seems to be a pea-shooter in the face of Fed action. What is your forecast for the Turkish lira and the South African rand against the dollar?
The framework in which the SARB works is completely different from that of the CBRT. First of all, because the South African Reserve Bank is a truly independent institution, and they just have the mandate to contain inflation within their 3-6% target. So if the currency keeps depreciating, and that has inflationary effects, then you could expect the SARB at some point to intervene by hiking interest rates, but that would be on the back of a deteriorating outlook on inflation, not on the currency per se, because they allow the currency to fluctuate in a decently free way, differently from what the CBRT is doing. Now, there's some spillover effect, so we have seen that moves in the lira and in the rand have been to some extent synchronized over the last few weeks in both directions. But having said that, I think that in South Africa as well as in Turkey, we continue to see a fairly bearish bias, which is mostly related to an overall macroeconomic backdrop that doesn't look very good. Growth is not high, is not really picking up decently. Current account deficit is very large, and most importantly, the country is losing international competitiveness, which requires a structurally weaker currency. So I think at some point the SARB will have to hike interest rates. But despite that, I think that the forecast against the dollar should look for rand above 11 over the course of 2014 and potentially closer to 12. While for the lira, we still have to adjust our expectations in light of yesterday's announcement. But I doubt that the lira can fall below the 220, 230 range to the dollar, even with significantly higher rates now.
Cristian, so very interesting to talk this through with you. Thank you so much. Well, viewers, that's all from me for the moment, but click back for an interview with Dura McDermott taking a closer look at that South African rate decision. Goodbye for now.